The hardware powering today's artificial intelligence models draws a massive amount of electricity. That energy converts directly into heat. Left unchecked, that thermal load will physically melt the hardware and force entire data centers offline. Keeping these environments functional requires highly specialized life support systems. Building and maintaining those systems is the core business of Vertiv. Vertiv does not design the AI chips, and they do not build the large language models. They build the physical environment that allows those chips to operate safely. It acts as a physical toll booth. Every time a cloud provider wants to expand its computing capacity, they have to pay for the surrounding power and cooling architecture first. Standard air conditioning is no longer sufficient for this hardware. The industry is rapidly shifting to liquid-to-chip cooling, piping coolant directly to the server racks to manage the extreme density of modern AI output. The physical limits of heat dissipation are the primary bottleneck for scaling artificial intelligence. The companies controlling the temperature inside the data center ultimately control the growth ceiling of the entire industry. This revenue model scales linearly with physical expansion. When a tech giant adds new server racks to handle user traffic, they must immediately purchase the accompanying power distribution units and thermal management systems to keep those racks online. Vertiv deploys end-to-end infrastructure, from the switchgear bringing high-voltage power in from the grid, down to the software monitoring the coolant temperatures. These installations are built to outlast multiple generations of the compute hardware they protect. Supplying the physical foundation for a massive tech boom is a highly profitable position. The complication arises when the broader financial markets recognize that profitability and aggressively price it into the company's valuation. A strong business model must be weighed against the high expectations set by investors. To see if Vertiv can justify its current market position, we have to look directly at their latest financial performance. Reviewing Vertiv's second quarter 2026 earnings report provides a clear view of their current operational momentum. This chart displays sequential revenue growth. In the second quarter, Vertiv generated $3.27 billion in sales. That translated directly to the bottom line, with the company posting a Q2 adjusted earnings per share of $1.40. This profitability is rapidly converting into liquidity. Looking back at their first quarter operations, Vertiv generated $653 million in adjusted free cash flow in just 3 months. This financial output is driven by structural improvements on the factory floor. Vertiv's adjusted operating margin expanded to 22.6% in Q2. They achieved this by combining high sales volume with the pricing power needed to offset their own production costs. Vertiv is increasing its sales volume while simultaneously stripping out internal inefficiencies. The result is a highly effective machine for generating cash. Based on this momentum, leadership raised their full-year 2026 net sales guidance to $13.75 billion. Meeting that volume requires rapid physical expansion. Vertiv is utilizing its cash reserves for strategic acquisitions, recently purchasing a company called Thermal Key to immediately expand their thermal management operations across Europe, the Middle East, and Africa. They also acquired a firm focused on engineered structural fabrication. This gives them the capacity to build and deploy the massive infrastructure modules required for utility-scale data centers at a much faster pace. Beyond acquiring manufacturing space, they are securing direct technical partnerships. Vertiv is actively collaborating with Nvidia to co-design platforms capable of powering and cooling gigawatt-scale AI factories. These architectures are already leaving the drawing board. At the U.S. Naval Postgraduate School, Vertiv's integrated infrastructure is actively supporting advanced, locally operated AI environments. By purchasing specialized manufacturing capacity and embedding themselves in the design phase with top chip makers, Vertiv is building a formidable physical moat around their business. The strongest argument for Vertiv's continued growth is its pipeline. Entering 2026, they held a $15 billion backlog, providing immense revenue visibility. They support this with deep reserves and a 0.2 times net leverage ratio, maintaining complete capital flexibility to fund future acquisitions. But high operational performance often results in a steep entry price. The primary risk for investors is whether this near-perfect execution is already entirely priced into the stock's premium valuation. There are also physical limitations. Executing on a massive, multi-phase infrastructure build exposes the company to severe supply chain congestion. Delays in raw materials can bottleneck their entire delivery schedule. Management has also noted specific financial headwinds in recent transcripts. International tariffs require constant mitigation and act as a persistent drag on their global profit margins. Vertiv's core business is thriving. The danger lies in whether market expectations will outpace the logistical realities of building heavy industrial equipment. This leaves the market to decide. Does flawless execution justify buying in at a premium, or is the hardware sector running too hot? This analysis is based strictly on historical data and public financial filings. It is for informational purposes and does not constitute financial advice. Stock prices will fluctuate as supply chains and valuations normalize. But regardless of short-term market volatility, Vertiv has cemented its place as the physical foundation of the AI rollout.